Hello, welcome everyone to this third session, to this fourth session on the Spring Talks organized jointly between the European Banking Institute and EU's field. This session is of particular importance and also makes me particularly happy to introduce, because it is the session where we will present and discuss the best papers presented at the best paper competition organized again jointly between the EBI and the EU's field. A call for papers was made last year with the provocative title of the financial sector's contribution to achieving ESG goals. The idea was to organize a young scholars writing competition where the best papers would be rewarded, and part of the process would consist in presenting those papers in a session organized to that effect. That session takes place today. The papers were read attentively by an outstanding committee, scientific committee formed by Professors Danny Bush, Victor de Serrier, Serena Grunewald, Paola Schweitzer, Michele Siri, and Beate Scheffel. And the result of this is the young talent that we have the pleasure of listening to today. I am moderating and discussing this event together with Professor Antonella Sciarrone Alibrandi, who is a professor and vice rector of the Università Cattolica del Sacro Cuore, as well as an EBI, a member of the EBI academic board, and the organizer of many events in this joint forum. Thank you very much, Antonella, for being with us today. The structure of the event is as follows. I will try to finish with this introduction as soon as I can. I will briefly introduce the different speakers, and then each of the speakers will proceed to do his own presentation sequentially, which will be followed by a brief discussion starting with Antonella, with Professor Sciarrone, and then myself, where the participants will have one last turn to reply to the questions or address our comments and elaborate further on their ideas. The three presenters who have demonstrated an outstanding research capacity are Marleen Och, who is a Ph.D. Researcher at the Jan Ronse Institute for Company and Financial Law at the Catholic University of Leuven. Mr. Antonio Davola, who is currently at the University of Bari, but has also been a Marie Curie Research Fellow at the University of Amsterdam. And Mr. Niccolò Giuseppe Cirillo, who is currently at the University degli Studi Brescia in Italy. The three papers are not only of outstanding quality, they are also complementary. The paper by Ms. Och will focus on sustainable finance and the EU taxonomy regulation. The provocative title is Hype or Hope. She will enlighten us on what are the pending challenges and the achievements of the EU taxonomy regulation and other EU regulations on sustainable finance. Mr. Antonio Davola will present the paper, The Promise and Perils of Sustainable Disclosure for Retail Investors. Does the Sustainable Financial Disclosure Framework tackle or rather promote greenwashing? So another provocative title, focusing more on the disclosure provisions contained in the Sustainable Finance Disclosure Regulation and the Taxonomy Regulation. And finally, Mr. Cirillo will present the paper of You Can Have Your Cake and Can't Have Your Cake and Eat It Too, why regulatory capital and TLAC MREL debt instruments can be automatically green. And I presume that he will give us plenty of reasons as to why. Since my idea was to do a very brief introduction after this, and thanking wholeheartedly all the participants for being with us today, I just leave the floor to Ms. Och. Ms. Och, the floor is yours.
Thank you very much. Good afternoon, everyone. Thank you so much for the opportunity to present my research here with all of you. I'm very honored to do so, and I will start by sharing my presentation. Okay, there we go. Somehow get unmuted when you do that, so that would have been not very useful for me to continue talking. So yes, let me jump into my paper, which indeed is titled Sustainable Finance and the EU Taxonomy Regulation, Hype or Hope. And for the sake of this presentation, I decided to also really focus on the taxonomy regulation itself. And I think that the three presentations today will complement each other very nicely. So maybe let me start by telling a little bit of the aim of this paper and the coming about of it. So I am, sorry. Okay, there we go. So I am a second-year PhD researcher at KU Leuven, and this paper was my first research project. I do my PhD research in the area of sustainable finance, but I usually write more on the role of shareholder engagement. And I started in 2019 to look into the taxonomy regulation as it was developing, as the TLACs were still ongoing, and I just found it incredibly fascinating and a very important piece of legislation. So I wanted to do further research and write something about it. And essentially, my paper followed two main aims. On the one hand, it was meant to be descriptive in the sense that at that point when I started to research it, there was just very little written on it at the time, and a lot of rather confusing information also in the press. And I just thought it would be very useful to have a sound, comprehensive overview of what the taxonomy actually does and doesn't do. So that was one of the goals. And then the other part was that I also wanted to, of course, dig a little deeper and evaluate it and provide an analysis of the main issues that I found and suggest some policy options on how they could be tackled. Yeah, the overall goal of this paper was always to rather provide a broad overview instead of focusing on one very specific topic. And I think that's also why it was well received outside of the academic context, because it is such a massive legislation raising so many questions that it's just incredibly useful to also have this kind of research on it, I hope. So yes, now let me go into my presentation for today, which will follow the same logic as the paper does. I will very briefly look into the sustainable finance framework and timeline. Then I will provide an overview of the taxonomy regulation, and then I will show the main highlights of my analysis. So first, I think it's important to remember how brief, what a short timeline all of this happened. So back in 2015, we had the Paris Agreement, and already in 2016, then the Commission appointed the high-level expert group on sustainable finance to draw up what then essentially turned into the Action Plan on Sustainable Finance in 2018. 2019 with the European Green Deal, and then following with the European Climate Law, the EU really set these targets, these emission targets into law. So the net zero emission for 2050 and a 55% reduction compared to the 1990 levels by 2030. And those goals are the underlying objective of most of the sustainable finance legislation, including the taxonomy. And the taxonomy was then adopted in 2020, so it hasn't been that long, and there are still many things up in the open, and it will be very exciting to see how things develop. And I think it's important to look at the taxonomy in its main objectives came from two different ideas of thought. So on the one hand, there was this, the EU identified this urgent need for more capital to in order to reach those climate targets it has set itself, and that just purely public funding would simply not be sufficient for that. And that indeed these capital market mechanisms should be utilized to provide for this additional needed funding. So the taxonomy really aims to redirect a lot of capital by providing these definitions on what can be considered sustainable or green or not. And then on the other hand, already in the markets, there's this issue that indeed the negative externalities are not really captured in the market price, that this was not picked up, for example, through a global carbon tax, and that because of this, the financial markets themselves already reacted on this problem by starting to offer different ESG type of financial products. And then indeed member states reacted on that by starting to adopt their own national legislation on these ESG investment products, which deviated from each other. So then the idea with the taxonomy was to have one European framework that underlies all of this, that on the one hand helps with this transition to a sustainable economy, but on the other hand sets these unified standards in order to avoid greenwashing. And the taxonomy also defines greenwashing as the practice of gaining an unfair competitive advantage by marketing a financial product as environmentally friendly, when in fact basic environmental standards have not been met. And this is one large goal of the taxonomy as well. So now let me quickly describe the taxonomy in its current state to you. So again, there is a few more detailed goals the taxonomy itself has. On the one hand, it wants to create harmonized language and build consumer trust into what products can legitimately be called green, and mitigate this market fragmentation that happened due to different member states and different financial market participants all going in slightly different directions on what they define is green. And then with this now one underlying framework, the idea is that it helps investors to make more informed investment decisions, and that also, on the other hand, it provides incentives for companies to transition to a more environmentally friendly business model, and help particularly those that are not currently considered green to have a target to aim for, to be aligned with the taxonomy and fall under the scope. Then, on the other hand, the taxonomy is just the one framework that now defines which economic activity can be considered environmentally sustainable, and this is very useful as a base for further policy and further actions. And all of this again features into the overall goal of the sustainable finance to just reorient capital to support those European Green Deal targets. And then there's three groups of mandatory uses for the taxonomy, while the group of voluntary uses might be larger. These are the three groups that have to apply it. On the one hand, we have the financial market participants, and they have to use the taxonomy on a product level. So they have to look at the proportion of this, the underlying investment, and then disclose the taxonomy alignment as a percentage level, so that then their clients can identify to what extent a specific financial product is taxonomy aligned. And furthermore, the taxonomy, which is very closely knit with the Sustainable Finance Disclosure Regulation, also introduced some amendments to said regulation. And then there are some more details on this exact product level style disclosure that are specified. And then the second large group that applies the taxonomy regulation are large companies, those that are subject to the non-financial reporting directive. And they apply the taxonomy on an entity level, so they just have to disclose usually which portion of their turnover would be aligned with the taxonomy. And then as additional information in their non-financial statement. And how exactly they have to do so is then specified in a specific delegated act that focuses on this Article 8, the article that mandates for those companies to do so. And then the last group of mandatory uses is the EU itself and the member states, again with the objective to not to harmonize the market in the sense that all member states need to apply this underlying framework for all of the standards or labels they want to issue in the realm of environmental sustainability. And then next up in Article 3, the taxonomy really explains, really defines what is taxonomy aligned activity. So it first needs to substantially contribute to one of the 6 environmental objectives that were chosen. Secondly, it cannot significantly harm any other objective. It also needs to comply with certain social right minimum safeguards. And lastly, it needs to comply with technical screening criteria, which in themselves actually only specify the 3 criteria above. So it's not really its own criterion, but rather just clarifies the exact detailed level 2 legislation thresholds. And then the environmental objectives can be found in Article 9. And as you can see, they go beyond the most known one, which would be climate change mitigation, and also include more detailed things such as pollution prevention, circular economy, and so on. And then there's also 3 different ways to look at these activities and how they comply with the definition of the taxonomy regulation. On the one hand is the low carbon or green way, and this is essentially the default option that just it applies as I just described. But then there are 2 additional types of activities, and those are transitional and enabling activities. So transitional activities are in themselves actually not would not fall under the taxonomy, but the reason they are included is that there is just this the idea is that there are certain very highly emitting sectors that are crucial for the economy and that will have to be around and that will have to change and become more sustainable in order to reach the 2050 emission targets, but where currently there is just no sufficiently sustainable alternative yet. And so the idea through this transitional category is to sort of incentivize a best-in-class behavior so that those companies that use the best environmentally friendly and still economically feasible method for something can still be rewarded, so to say, by being included in the taxonomy. And important here is, though, to find a balance between incentivizing companies to do so, and at the other hand, not having a lock-in into carbon-intensive assets that then stay there for a really long time, even though now much more environmentally friendly alternatives have emerged. And yeah, an example for these kinds of industries where it's difficult to find this balance is, for example, in the steel and cement production. And then we have the enabling activities. And here the idea is that they do not themselves make such a contribution to one of the environmental objectives, but that they directly enable another activity to do so. And because of that, they should also be included. They should also have the possibility to benefit from this extra capital by being included in the taxonomy. And this can, for example, be something as manufacturing of renewable energy technologies, where the manufacturing itself may not make the contribution, but is obviously necessary for the renewable energy technology in the end to work. So those are the types of activities covered under the taxonomy. And now looking a bit further, ever since its adoption in 2020, there has first been the Climate Change and Adaptation and Mitigation Delegated Acts, which really specify for a lot of industries these thresholds that need to be reached for each activity, for both a substantial contribution, but also for the do no significant harm bottom line, so to say. And then there's been a delegated act specifically looking at Article 8 and how the methodology and the presentation of these information by by the companies falling under the Article 8 should look like, and which key performance indicators can be used to make their performances very comparable. And then there is, has also been a lot of debate on the question of whether to include nuclear and gas energy activities under the taxonomy, which goes to show how political it can be, even though it claims to be a purely science-based, politically neutral piece of legislation. Yes, so that's also interesting to observe in any case. And then to see how much more is still coming and how many developments are happening. This is an overview of the work that the Platform on Sustainable Finance does, which is the group that took over from the technical expert group, which initially drafted a lot of information that was used for the taxonomy. And now essentially this platform is meant to give very good science-based research and suggestions to the Commission on how to adopt different delegated acts. And they are working on the one hand to really define these technical screening criteria for the different sectors, but they're also looking into other areas, for example, whether there should be such a thing as a social taxonomy next to this environmental taxonomy that we currently have, but also whether it would be useful to include negative or low impact activities. Yes, and now that brings me to the analysis part of my paper. And I will, so what I've done basically is that I first look at a specific goal that the taxonomy formulates, then look whether there are any problems with that, and then look into whether some policy options exist to mitigate that problem possibly, and which different options and how to possibly balance them, or where objectives also collide. And so first, for example, looking at this goal to redirect capital flows towards sustainable companies, this overall big transition of the economy angle, there we can wonder, is there sufficient focus on this transition aspect, given that currently what taxonomy does is really define sort of a niche, best-in-class, very green activities that only cover a very small fraction of the current economy. So the question is whether we can just expect that to change, also knowing though that the thresholds for taxonomy alignment will be adapted continuously and be harder and harder to reach, or whether it could be useful to widen the transition criteria to allow for more activities to be possibly taxonomy aligned. And then within that debate, we can also wonder, though, if it might be more useful, instead of widening this green sphere that the taxonomy currently has, and that is quite niche, so to say, instead extending it to a full scale, which also sort of, with following a traffic light system, includes medium aligned or medium sustainable and unsustainable or harmful activities, and thereby just including more of the economy under the taxonomy regulation, just under different thresholds. And the question also, or another problem with this idea of this very big transition, is though that there is not that much data or studies yet on the risks and the profitability of ESG investment. So it's always something to keep in mind when enhancing this legislation and possibly nudging investors into a specific direction, that there's still more research needed in this field as well. So it's also important from a political perspective to keep that in mind when making these kinds of decisions. The second goal, to create a harmonized framework based on the same metrics. Here the question is, one, interoperability, especially on an international scale. Taxonomy now mainly uses EU-wide frameworks. And then another question, just the cost and availability of data. Especially for smaller companies, it will be very expensive to get to disclose all of this information and to gather it all in time. Same for financial market participants, where sometimes the timelines don't really match and they need to disclose data which they cannot get from the companies yet. So there, when we look at the policy options, there is a proposal for the corporate sustainability reporting, which just widens the scope significantly on companies that we need to report. So we could expect more data coming our way through that. At the same time, it employs a lighter regime for SMEs to not have such a strong burden when we're looking at the costs. And then this also raises the question whether ESG rating and ESG rating agencies are sufficiently regulated, because they currently provide a lot of this kind of information to financial market participants. Then the next goal that the taxonomy has is to be able to depict just in one simple graph or in one simple number, taxonomy line, yes or no, and the percentage of it. So it's meant to be very readable, very easily understandable. But as I think we will see with the following presentations, there is actually so much more than just this very clear taxonomy, yes or no, especially in the SFDR. And the question is to what extent that is comprehensible for investors, particularly retail investors. It seems that they are not sufficiently protected by this type of through this type of regime, and that may be indeed also for them. It could be useful to extend the scale or to introduce more labels and easier understandable labels to allow for them to understand. Then the next goal is to have one underlying system for the entire EU that all works together. And similarly here, the problem is the diverging timelines and different products under different regulations. So I think here it would also be useful to see to what extent they could maybe be aligned under different kinds of labels.
Marleen,
yes?
just one point. It's 21 minutes. I mean, I'm telling you in advance, you still have 4, but just so you make the best use of your time. Thanks.
Okay, thank you very much. Yes, then the next question actually, I mean, one of the main goals of the taxonomy was to provide this framework so that already the existing ESG product market would be regulated and easy to understand. But actually, there's only a very small fraction that is now covered because, first of all, we have no taxonomy on the S for social and the G for governance. And even within the E, not everything is covered. So this raises the question whether to extend a taxonomy that actually covers everything that is offered on the market, or whether to see that the market rather adapts to the regulation. And then the last point, and this is the one I will elaborate a little more on my next slides, is to prevent greenwashing. And here the question is to what extent this is currently the case or not, particularly looking at retail investors. And here I think that the taxonomy in its current state is actually not sufficient to protect retail investors from greenwashing, and that assuming that we will have a lot of this ESG data in the future, that it will be very crucial to, on the one side, have a very granular, very nuanced metrics in these technical screening criteria, but then on the other side, need to make sure that they are then turned into a very easily understandable depiction for investors. And as you can see here in an example, for now, what investors know is only whether something is taxonomy aligned or not, and they do not really know what the other investments might include in that regard. So I think here it would be really useful to introduce this traffic light system, and that could look something like this. So this is one on the left side. This is from the Climate Bonds Initiatives taxonomy, which has such a traffic light system. And on the other side, you can see how things would develop without such a system with the current taxonomy. So right now, sort of a niche product, you see only a small part of a portfolio would be taxonomy aligned. And while this part would increase, hopefully the rest would still remain undefined. So I think extending would really help to avoid that. On the one hand, we have a very costly niche product as a taxonomy aligned product. We could benefit from the thresholds that taxonomy already provides, the upper and the lower threshold, just utilize those for the green line and the red line, so to say. I think this would prevent from this dilution effect that otherwise, especially retail investors would not really be sure whether this taxonomy now is even green anymore or not, if we include too many transition activities in it. And lastly, I think because of this, it mitigates the risk of greenwashing in the remaining portfolio that would otherwise remain undefined. Okay, thank you very much for your attention.
Thanks very much, Marleen, also for the exquisite management of time. So I hope that we will have a very fruitful discussion afterwards. But before, please, Mr. Antonio Davola, the floor is yours.
Okay, everything should be worked great. Thank you so much. So before starting and trying to make a wise use of my roughly 20 minutes, I just want to thank you, of course, Professor Munoz and Professor Siri and Professor Sciarrone for being here actually and for the wonderful chat, but also Professor Grunewald and Professor Bush and more in general the European Banking Institute and the youth field for this actually wonderful opportunity to be able to present my paper, for the like super kind words that I spent way too much actually on the research, and to be able actually to discuss this research I'm conducting in front of such an outstanding actually audience. And also actually thanks so much to Marleen for like setting the ground on one side of the discussion that we will have today, so to providing such a profound overview of the taxonomy regulation before we do move to the topic of my speech today, which is closely connected but not entirely overlapping with that, which is of course the sustainable financial disclosure regulation. So like the other half of the sky of these two bodies of law are considered. And so today I'm presenting my research that is entitled The Promise and Perils of Sustainable Financial Disclosure for Consumers, or for retail investors in particular. And as Professor Munoz observed, I tried to be rather provocative with the title already. So I tried to investigate whether the SFDR framework is actually able to tackle, or rather even favor or promote greenwashing, which we'll consider the focus of my discussion. Now, just to provide, once again, my knowledge, a very brief overview of the framework for the research. Now, since within the European Commission Action Plan on Sustainable Finance, of course, we do know by now that a significant effort has been made to introduce sustainability-related disclosure rules on investment. And we do know that they are regulated both by the SFDR, which I will focus on today, and in part by the taxonomy that Marleen already discussed in depth. But amongst the declared goal of the action plan, we do, of course, have the underlying idea of reducing the information asymmetry between end investors and financial market participants in order to promote our investment decisions that can consider sustainability and sustainability risk and adverse impacts. In particular, amongst this idea of within this idea of reducing information asymmetry, contrasting financial greenwashing has been seen as a pivotal goal of the regulation. Of course, considering that greenwashing is detrimental both to investors' decision making and for the market more in general, and we will see why. Because of course, we can just say that it diverts resources towards what is considered a fictional sustainable investment, so what is actually not promoting ESG sustainable goals. So one primary goal of the regulation is to allow end investors to actually efficiently compare investment opportunities and to figure out when they are dealing with an actual sustainable investment. And these framework, even if we are talking mainly about the SFDR and the taxonomy regulation, it must be mentioned that this system is also supplemented by a significant set of delegated acts. And within those, in particular, the regulatory technical standards that are supposed to implement and to provide template for the SFDR are particularly relevant. And I mean, the idea of presenting today was also particularly timely because the last version of the regulatory technical standard has been actually published on the 6th of April. So that was very timely, and we will devote some time also to analyze the regulatory technical standard. But those delegated regulation will only start operating from January 2023 onwards. The interesting thing is that while this happens, the SFDR is nevertheless into force, because the underlying idea is that the Sustainable Financial Disclosure Regulation operativity was not conditional to the presence of the regulatory technical standard, given the self-sufficiency in the European Commission's words of general principles of sustainable related disclosures. So when I started analyzing actually this topic and this like very complex framework of level 1 and level 2 regulation, the question that came to my mind as a decision-making law scholars was, okay, does it work? Like in simple terms, I wanted to figure out and to start thinking whether these like provisional regime that is being designed by European regulator actually promotes investors and in particular retail investors awareness regarding greenwashing, or actually might end up paradoxically favoring or even like not tackling the greenwashing phenomena. So the idea actually to start throwing some provocative aspects and see how they have been developing throughout this year actually. So let's start by saying a few words about greenwashing in the market and in financial markets more specifically. So the debate around greenwashing as becoming some sort of an interesting corollary of the debate on sustainability. And this is, of course, because in recent years, sustainability arose as a central driver for market development. And this is not limited to financial markets, but it's actually happened horizontally with sustainability becoming a major driver for consumption in general. And of course, since sustainability is a driver for consumption, this means that sustainability, communication regarding sustainability became a powerful marketing tool for companies. And we have also empirical evidence regarding the relevance of sustainability for consumption. So we see that consumers are increasingly willing to modify their consumption habits in order for products they buy to align with their values, and they declare to be willing to change their shopping habits to reduce environmental and socially harmful impact. So, and also this is one other thing that we will discuss, both environmental and social sustainability with regards to this topic. Now, this doesn't mean that consumers nowadays are willing to let go any interest in price and performance of the products, which are still the main drivers for consumption. But nonetheless, it is nowadays undeniable that the traditional price-driven considerations is being integrated with purpose-driven elements in decision-making. So if on the one hand, this is true for consumption more in general, this is significant for financial markets in particular, and this became more and more significant as soon as the ESG criteria actually became part of investment mainstream. As we can observe, we have been seeing an increasing number of funds and products trying to be rebranding towards ESG, and we have seen that financial operators have been becoming actually to issue financial products and services that support specific climate-related, environmental, or social products that are branded as sustainable. And we are still in the process kind of figuring out the structural reasons behind investors and shareholders' interests for ESG or for corporate social responsibility as well. There are different concurrent theories, but still what we can see is that there is a trend, and that this trend is generally welcomed by European institutions and legislators more in general, also in light of the traditional difficulties that governments have into policing environmental externalities. And in order to hold up this promise that actually sustainable finance can promote responsible development, in recent years we have been seeing a significant effort to introduce sustainability-related rules on investments, and the taxonomy regulation that Marleen has been mentioning and analyzing is, of course, one or two of them. Now, of course, though, with firms increasingly communicating about sustainability, also comes the risk of companies distorting and even feigning their so-called environmental credential if we want to attract consumers and to increase market power. And this is, of course, the problem that we face with greenwashing. And recently, the proliferation of sustainability-related misinformation actually became a substantive element on the market, as it has been observed also by empirical studies conducted by European institutions in online sustainable environments. Now, this is why as soon as companies started to brand and rebrand their products as eco and social friendly, the Financial Sustainable Action Plan tried to introduce a set of duties for advisors and financial markets agents in the best interest of their clients in order to kind of contract the system. And of course, this comes from the fact that greenwashing has, and we all know about that, significant detrimental effect, both of investors' decision-making and on the market. Because of course, greenwashing misallocates capital, it hinders the transformative process that is supposed to lead to sustainable markets, and it has a direct effect, of course, on corporate performance as well. It affects corporate legitimacy and reputation, and overall it increases investors' confusion and skepticism towards the effectiveness of financial markets in promoting sustainability goals. And we do know how relevant actually trust is for market development. So within the strategies that have been identified kind of to empower retail investors against greenwashing, disclosure has been seen as a cornerstone for investor empowerment, and the empowerment via information actually arose as a primary strategy. And this is consistent with what has been happening for a long time in financial market. This is not unusual, and these like very strong interest for empowerment via information and disclosure duties come from a set of like both conceptual and very practical rationale that is worth mentioning. So of course, this great usage by financial markets regulation of disclosure duties comes from the fact that they are a cheap regulatory tool on the one hand, if we want to say that. So once they are creating, extending their scope or content, do not like require significant expenditure or economic resources. Also, introducing disclosure duties and information duties, also from a very political standpoint, usually enjoys some, let's say, bipartisan support, because disclosure duties do strike a very convenient balance between what we might consider like a paternalistic view, and on the other hand a liberal one, by introducing rules but not being like stringent command and control elements and devoting a major aspect of control on supervision. And with regards to supervision, of course, disclosure duties are very convenient because they do introduce some sort of ex-ante system that creates transparency and clarity for companies and for supervisory authorities that can actually enforce them very practically. This is for like these three rationale are mostly related to the practical reasons behind this usage of disclosure duties, but of course there is a conceptual one. So, and this idea is that since we want to overcome the information asymmetry that is at the core of greenwashing phenomena, providing retail investors information is consistent with our view of investors or individuals more in general as homini economici, that comes from the neoclassical approach to decision making, and which actually tells us that if individuals are provided more information, they can make better investment decisions, because this reduces their search cost and allows investors actually to align their preferences with what they actually look for. And also this idea is also related to the fact that from a macro perspective, the presence of more information on the market should foster competitiveness, reduce information advantages in the professional, so the principal agents relationship, and also might like reduce market volatility more in general. Now, of course, we are aware that the neoclassical approach has been increasingly disputed in recent years, and especially behavioral economic scholars have been strongly criticizing this effect by showing that investors do not behave as the neoclassical system would operate. And even if the European institutions acknowledge that in part, behavioral finance, neoclassical system and disclosure duties still represent the main tool for regulation, at least when we think about investors' empowerment. And consistently with this consideration, also the action plan introduces a major, let's say, set of disclosure duties towards investors for all market participants. And in particular, in determining the content and the structure of these disclosure duties related to sustainability, what we can observe is that the structure of the SFDR is actually intertwined with the one of the taxonomy regulation that has been already analyzed, and they do interact both substantially and chronologically. So the SFDR operates by introducing both disclosure rules and fiduciary duties that are meant to facilitate comparison among sustainable products. So it actually establishes those should be subject to these duties, which products are covered, and under which conditions investments are supposed to be qualified as sustainable or in general. Then it also diversifies the set of disclosure based on whether the advised products promotes environmental or social characteristic as its main target. So it's a so-called dark green product or an Article 8 product, if we want to refer to the SFDR framework, or actually only promotes them as a secondary element. So within another goal actually has an environmental or social characteristic that is worthy of consideration. It has the so-called light green or Article 9 framework. And then it also identifies those remaining products that are so-called brown products, so that have adverse sustainability impacts. Lastly, the SFDR, as we know, embraces a so-called comply or explain system. So if sustainability risks are not deemed relevant by the advisor, so are not disclosed, a specific justification must be given. And the criteria for distinguishing amongst these different categories are provided by the taxonomy regulation, so I will not spend time discussing that because also Marleen already observed that. But what I want to underline is that this first level is actually intertwined with the second, the so-called level 2, because the modes and methodologies and layouts for the disclosure that is prescribed by the SFDR must be established and specified by means of secondary regulation, and in particular by the regulatory technical standard that were published in their last version on the 6th of April. Whereas the specific threshold for the classification are provided by the technical screening criteria that are the secondary regulation for the taxonomy regulation. So what I wanted to figure out, also something that is worth mentioning as well, is that when we consider the disclosure for products within the SFDR, we do have a so-called 3-level framework. So the disclosure that must be provided to retail investors is divided in kind of 3 venues. The investors must be provided information before concluding an investment contract. So we have a pre-contractual level, but at the same time, useful information and different information from the one that is provided at pre-contractual level must be present both in the website of the company promoting allegedly or actually sustainable products and within periodical report. So we do have 2 different sets of regulation operating like alongside each other and mutually affecting each other. And then within the SFDR, we have different layers of disclosure and different obligation that comes to level. And I wanted to understand whether these actually system, I wanted to question whether this system is actually effective to empower retail investors. And if like research-wise, I find comforting that also Marleen came actually at my same point, actually reached that this system might be debated in terms of effectiveness. Of course, this is very uncomfortable in terms of the ability of the overall framework to promote sustainability goal overall. So I started analyzing this system, and in particular the SFDR system, and I tried to figure out which shortcomings could be identified at product level. And in particular, I have observed that this kind of multi-speed track and multi-level track can create a set of significant risks in terms of awareness of retail investors, especially when greenwashing dynamics are considered. So, and interestingly, when I was analyzing the effectiveness of this framework, I identified 2 different set of problems that we want to consider in terms of investors' protection. And one block of risks actually that I do call inter-temporal drawbacks comes from these like temporal gap existing between level 1 and level 2 regulation. So the absence of a definite form of regulatory technical standard while the level 1 regulation is already in place. But I also found a second set of risks that I do call structural drawbacks, and which do not depend actually on the absence of a complete level 2 regulation, but are related to the general structure of the framework designed by the regulator. So in order to be time-wise, I will not analyze all of them. We'll just focus on a couple of intertemporal drawbacks and a couple of structural drawbacks before concluding that. So as for intertemporal drawbacks, what I want to underline is that the RTS were supposed to provide essential clarification regarding some notion employed in the SFDR, and therefore, especially for example, the definition of green light product was kind of missed, and this was supposed to be a major problem in the absence of the RTS. Now that the regulatory technical standards being published, I would actually move, this first version of the paper was done before the 6th of April. Now that the regulatory technical standard has been published, I would move this to the structural drawbacks, because as we will see, the regulatory technical standard did not provide a useful definition on that. But as for the intertemporal drawbacks, what I observed is that in the absence of the delegated regulation and in the absence of a clear-cut definition of acceptable indexes that was mentioned by Marleen as well, this could have created kind of very strong confusion on retail investors regarding the methodologies for sustainability assessment, and therefore be detrimental for their decision making. And when we consider the structural drawbacks, the main problem that I face in the current system is that employing a multi-track system with different venues for disclosure and different regulation coming into place, if on the one hand was meant to reduce information overload, so to say, actually you find some information in the contract, some in the website, and some in the periodical report, can also favor information dispersion and information complexity, because then investors do have to look for this sort of information in different venues, and this could also create fragmentation in terms of decision making. And even when we do not consider the fragmentation of decision making, current RTS do offer significant problems in terms of understandability. So it is questionable whether in the way they are currently structured, they do actually empower retail investors in terms of decision making. This is a study that was conducted actually for the first version of the RTS, and that demonstrates that consumers were not actually able to understand, and retail investors were not able to understand with much needed clarity what was the main aspect of the communication regarding sustainability, and they didn't find, let's say, easy. They were not able to figure out clearly the characteristic of the investments they were subscribing. Interestingly, these...
Just one point, Antonio. You have 2.5 minutes, okay?
Yes, I know. I'm on time. I have my alarm here, so I will be on time. I will try my best. So, as I said, the interesting thing, just to shed a light on something new that happened very recently. As I was saying, on 6th of April, the new RTS has been published by the Commission, so the new delegated regulation has been made public. The interesting thing is that the final version of the RTS is not likely to change the situation, because it doesn't address the critical aspects that I underlined in my preliminary analysis. It doesn't provide a formal definition of Article 8 and 9 products. It doesn't provide a minimum threshold for qualifying so-called light green products, and it doesn't provide guidance to tell us, for example, what contributes to an ES objective. So actually how this contribution, that is not the main goal of the investment, has to be considering. So this is from a substantive perspective, but we do find significant problems in terms of investors' awareness, even if we analyze the structure of the templates that are provided in the regulation. Because if we observe, this is just a minor example, if you observe the disclosure system for Article 8 and Article 9 products, so light green and dark green products, we can observe, I cannot get into depth of that many aspects related to the communication to the investors seems to be relevant for supervisory goals instead. So for example, it's very difficult for an investor to figure out how a benchmark was actually developed, so to inspect the methodology, even if that's one of the requirement that the SFDR and the regulatory technical standard mandates. So the last version is not meant to fulfill all the criticals that were raised already. So just to provide a final perspective in the 30 seconds that I have left, the underlying idea, so the critical getaway that we get is that in light of problematic system that was already being identified by the ESA since 2021, the development of the SFDR framework and the RTS doesn't seem actually to represents a step forward, but doesn't seem to avoid any risk related to retail investors and retail investors' understanding and aware decision making, and therefore many critical aspects are still present with regards to its effectiveness in order to actually curtail greenwashing phenomena. Thank you so much.
Thank you very much, Antonio. Thanks also for staying on time. So without further ado, we will just move on to Niccolò's presentation. Niccolò, whenever you're ready, the floor is yours. Thank you.
Thank you, everyone. Yeah, before starting, hopefully you are seeing my presentation on screen. Just shout if this is not the case. Anyway, yeah, before starting, I would like to thank the EBI and Newsfield for this opportunity. Of course, I would like to thank the panelists, so Professor Sharon Alibrandi, Professor Siri, and Professor Munus, and of course, the two colleagues of mine that just gave a very interesting and thought-provoking presentation. So thanks. Yeah, let's start. I'll be very concise. I promise that. Yeah, the main topic of my paper can be, let's say, easily summed up in a series of questions. That is, whether it's conceivable to have something like a green regulatory capital MREL TLAC stack, or put it differently, could we accept own funds, more generally MREL TLAC instruments that at the same time guarantee effectively and truly the pursuit of ESG objectives? As you know, for financial stability purposes, credit institutions are required to capitalize themselves also, mainly, I would say, via issuing capital instruments, so-called own funds, TLAC instruments. And such instruments should comply under the Basel III standards, the CRR's regulation, with several so-called eligibility criteria, permanence criteria, remuneration features, loss absorbency features, availability features. Yet, interesting scenario may arise when green bonds, particularly so-called use of proceeds bonds, but this is also the case for new generation sustainability-linked bonds. Anyway, when use of proceeds bonds are elected as own funds, TLAC instruments in the relevant capital stack, because the very characteristics of such ESG green claims, I'm using the terms ESG green interchangeably, but of course my presentation focus and my work focus on green claims. Anyway, I was saying interesting scenario arise when these ESG green claims are elected as own funds TLAC instruments, and they interact and possibly clash with own funds MREL TLAC eligibility criteria, as the case may be. The outcomes of my work is basically based on not only academic research, but let's say that the bulk is based on professional experience I had first time ago at the European Banking Authority, as of recently at the Bank of England, and as of now, I would say very recently at the Single Resolution Board. Anyway, in addressing such question, my presentation will be organized as follows. First, I'll briefly frame the very general issue that sits at the basis of my investigation. Yeah, as I said, whether and to what extent environmental and financial stability goals could be pursued jointly without frictions in the field of capital definition, particularly. Secondly, I'm going to move to the analysis of the current legislative framework, defining what green bonds, more generally ESG bonds, are. And in doing so, I will detail the characteristics and the features of so-called use of proceeds green bonds that are also called first generation ESG bonds. As I just said, to be honest, currently in the market, we are seeing another category of green bonds that are actually actively traded, that there are sustainability linked bonds, as I said, and which are also called second generation ESG bonds. I'm not going to focus actually that much on these bonds in my presentation, and I haven't focused that much in my work on this particular structure of bond, but I'm happy to spend a few words if necessary of them, because it happened I work on them like very recently, and they're becoming very popular as of nowadays. Anyway, when it comes to use of proceeds green bonds, I will present the main clashes that their core features could give rise to when interacting with own funds, MREL, TLAC, eligibility criteria. And then finally, I'll try to sketch some solutions for firms that are willing, let's say, to pursue environmental objectives in the regulatory capital TLAC space, but still via the issuance of green bonds. So let's say in taking that are firms that are willing to take two birds with a stone. So let's start. I provide more details actually on the green bond notion in the next slide, but as I said, when we talk about green bonds, we basically refer to instruments whose objective is funding projects that have a positive environmental or societal impact. And as I argue in my work, I believe that credit institutions, via the issuance of such instruments, have the capacity to perform a positive role in the channeling of funds towards carbon neutral investment projects. But actually, my work on interaction between ESG and TLAC qualifying criteria is underpinned by another broad question, that is, to what extent environmental objectives can be pursued jointly with financial stability and prudential soundness goals. And more importantly, there are a second question, that is, what approach prudential regulators are supposed to take with bonds treated as TLAC instruments, but that also supposedly pursue ESG goals. Yeah, to be honest, I'm not dealing much on this latter point on my paper, but just to give a few words here, I believe that regulators should be, and I would say actually regulators are neutral and not really and should not really be concerned by the ESG environmental features of these bonds, as well as their desirability and purposes. This is for a couple of reasons. First reason is because prudential regulators' main goal should be assessing the prudential feasibility of such bonds, not their social desirability, not their environmental impact. So for them, like the green ESG label should not be treated should be treated as a label. So there's something they should not really be interested into. And also there's a much wider point here, because actually regulators at the moment, I would say, at least Europe-wise, possibly lack any legitimate mandate to act accordingly to pursue environmental related objectives. And actually, you know, we see the seeds of such debate also in possibly more important topic as the pursuit of monetary policy, whether it should be targeted towards environmental objective or not. Anyway, with this general background in mind, I'm gonna move to the bulk of my work. That is, I'm repeating myself here, an inquiry on how green features interact with the current definition of capital for prudential and regulatory purposes. And in order to do that, I need first to detail green bonds' main features and characteristics. So at the international level, it is possible to identify two different types of environmental conducive bonds, depending on the mechanism underpinning the promotion of ESG objectives. So we've got so-called first use of proceeds green bonds and sustainability linked bonds. They are also called SLB bonds, while the B is repeating here. In my work, as I said, I focus on the former, so I'm going to present now the main characteristics of use of proceeds bonds, and then in the next slide, I'll detail under what circumstances such characteristics interfere, may clash with own funds TLAC criteria. So the most relevant legislative bodies where nowadays use of proceeds green bonds are disciplined are the 2021 ICMA Green and Social Bond Principles and the 2021 European Commission proposal for a regulation on European green bonds. Now, none of these texts is hard binding law, The former belongs to the classic soft law soft law realm, while the latter is still a proposal that not yet adopted by the EU Parliament and the Council, but they can be analyzed jointly because they share many similarities, especially in defining the use of proceeds approach. And namely, for both pieces of legislation, the definition of an use of proceeds green bonds sits on the needs first to utilize the funds raised via the bond for financing or refinancing green projects, and secondly, on the needs to put in place processes for tracking the net proceeds of the green bonds. And this is the crucial issue at stake here. The fact that green bonds may imply green assets to be earmarked, ring-fenced, segregated from the rest of the other assets on the issuer balance sheet, and this due to the establishment of a link and a connection between green assets on the one end and green bonds on the other end, so that there is no fungibility with other institution assets. So as I'm going to detail in the next slides, the main prudential issues coming from a use of proceeds approach stems from the strength of the link between the performance of the green capital bonds and the performance of the underlying assets. The issue, as we will see, is entirely a legal issue that is pertain to the strength of the issuer commitment to allocate and accordingly segregate green bonds proceeds from the rest of the other assets, and so its relation with its relation with the rest of other institution assets, and particularly their exposure to losses. Now, before detailing and moving to such issue, we need to spend a couple of words on the post-financial crisis regulatory capital concept. In a nutshell, and in order to promote effectively institutional loss-absorbing capacity, both Basel III and its European transposition, that is the CRR, CRD packages. Now we've got the CRR2 and the CRD5 packages. Possibly there's going to be a CRR3 version. Anyway, they detail these bodies of law detail a series of criteria that capital resources should comply with in order to guarantee an effective going concern and gone concern loss absorption capacity. I'm not going to detail actually all these criteria here. They are quite extensive, but I'm going to detail some of them afterwards. But what I would like to stress, though, is that such criteria rest on one principle. That is that regulatory capital and TLAC instruments should cover all losses in the balance sheet of an institution, notwithstanding when such losses originate, and notwithstanding on what assets they arise. And this is the so-called principle of capital fungibility. Now, why should use of proceeds green bond be raising an issue with that? In my paper, I argue that the green commitment, that is the earmarking of proceeds raised from green bonds, so their non-fungibility with other assets on the issuer balance sheet, may be interpreted as an impediment to use such proceeds to cover losses stemming from all other assets, stemming from all parts of the business of the bank, but only to cover losses arising from green assets, so that it follows electing green bonds as AT1, Tier 2, and eligible instruments may raise such impediments. And while actually in the market we are seeing that banks issuing entities in general usually affirm that proceeds raised from green bonds are in fact fungible with proceeds raised from let's say common assets, non-green bond assets. Well, one may wonder, actually this is a point I hold in my paper, one may wonder whether an effective green commitment to exclusively use green proceeds for green-related projects also implies that green bonds should not be considered fungible with non-green bonds. So that, and this is the point that one of the points that I make in my paper, we got a conflict that cannot be fixed. that is, a truly green bond cannot be elected in the TLAC stake, because a truly green bond should be based on this proceeds segregation idea, and also a truly TLAC claims cannot be incorporated into an use of proceeds green bond, because a truly TLAC claims is like fed into the concept of capital fungibility that is somehow at odds with the green bond idea, especially in underpinning use of proceeds green bond, that is, as I said, segregation of proceeds. There's a second possible point of friction between use of proceeds green bond and TLAC qualifying criteria, and this pertains to the so-called permanence features of the latter, of green bond, of TLAC and own funds instruments. Basically, in a nutshell, own funds as well as bail-inable debt instruments have to comply with different degree of strength, but anyway, they all have to comply with different several provisions whose ultimate aim is promoting the stability of the capital base. So the CRR prohibits or limits to various degree instruments early redemption option upon the issuer. It prohibits structure that could give rise and incentivize the issuer to redeem the notes, so-called incentive to redeem. These are prohibited, actually permitted for TLAC, but there is still a penalty there. And the CRR requires the issuer not to indicate or give any perception that the instruments may be called earlier than maturity. Again, what's the issue with use of proceeds green bond here? Well, in my paper, I make the case that the non-fungibility of proceeds that may underpin green bonds may incentivize exactly such prohibited behaviors. And if you think about it, this is the case if the original assets are disqualified as green assets, or the issuer failed to invest the proceeds raised in green assets, or green assets come to maturity prior to the minimum duration of the ESG bonds. Of course, when we talk about minimum duration, I mainly refer to Tier 2 and eligible liabilities claims, as 81 claims are supposed to be perpetual. Anyway, in all these cases, I suggest there may be a perception issue upon the holders of green bond, in the sense that such scenarios could be perceived by investors as obligations, indication for the issuer to actually redeem the instrument. There is also a third point, that a third scenario where conflict arises, that pertain to subordination. Also, this may be considered like a kind of perception issue. So based on the holders of these claims, as you know, the insolvency and the creditor hierarchy, the insolvency cascade for 81 tier for prudential, for own funds and eligible liabilities is quite clear under the CRR legislation. We've got 81 that claims subordinated to tier 2 claims, and tier 2 claims subordinated to eligible liabilities. What I wonder, though, is whether the ESG green label could give rise to the idea of a preferential treatment in terms of insolvency hierarchy of these claims in relation to all others own funds claims of the institution. And yeah, this is somehow connected to the point I raised before. If we imagine ESG bonds as something that use of proceeds ESG bonds as something that only is exposed to losses stemming from ESG assets, then investor may be tempted to consider their claims as preferential to other claims, to the extent that they are not supposed to absorb losses stemming from non-ESG assets. So this is this. So also from a bail-in scenario here, a resolution scenario here, you may have some so-called NCWO issues. So, and I'm moving to the last slide of my work. In conclusion, in my paper, I argue that own funds and TLAC instruments in their current definition offer very little room for factoring a green commitment in the form of a use of proceeds green bond. And this is because, as I said, a green commitment achieved via proceeds segregation is at risk of colliding with different prudential provisions. And as I argue, that is probably the parse constraints of my paper. I argue that such form of green commitments are best factored in senior bonds, so in the senior layer of the capital stack of an institution, because in this layer proceeds segregation could be legitimately pursued. So this is the capital layer where credit institutions should favor for greening their balance sheet and also for providing a serious green commitment, I would say. Anyhow, should credit institutions be keen to somehow pursue green objectives via the on-fund TLAC spaces? In my paper, I have briefly sketched two different structures whose implementation do not require any proceeds segregation. But the first structure I propose is that of green coupons that are paid to Tier 2 and other MREL debt holder, whereby an obligation to pay such holders is subordinated to green assets being performing. Of course, you've got a problem here that pertains to the feasibility of such structure, because instruments holders would not only bear the risks inherent to an on-fund TLAC instrument, but would only be remunerated when green assets are performing. So they are not, these claims, I dare to say, like the idea of a green coupons may not be really attractive. And in fact, I've never, yeah, there's something in the market going on that resemble this, but these claims are channeled towards very niche sector. The second structure I briefly propose in my paper is that of a green write-down conversion triggers. That is mainly for AT1 instruments, but may also work for Tier 2 and eligible liability instruments. That is a trigger that activates instruments cancellation or conversion when a certain green metrics threshold is hit. So the trigger would ideally incorporate firms' environmental performance, but the main problem here, the main problem I signal here, is basically a problem of reliability. That is a problem of finding reliable green indicators, of finding reliable key metrics, so-called key metrics indicator capable of tracking correctly firms' environmental performances. So, yeah, this was the last slide of my paper, and happy to take any questions on what I presented. And thanks for your attention. Thank you.
Thanks very much, Niccolò. I'm sure there will be questions and comments. I wish to just leave the floor to my very dear colleague, Professor Chiarone, to start with the discussion. Antonella, the floor is yours.
Thank you, David, and thank you, Niccolò, Marleen, and Antonio, because I think that your papers are really interesting, and also today your presentations very interesting and appealing, so not boring at all. So I would like add some remarks in general, and more specifically with regard to Marleen's paper and Antonio's paper. But at the beginning, in general, I would say that I really appreciated all three of the papers you presented, because you take a critical approach, but constructive approach to the new framework on sustainable finance. And I think that this is important and also really helpful at this stage. And more specifically, I would also note that all three of you reach similar conclusions about some points, starting from different perspectives, but the conclusions are really quite similar, and I think that it's interesting, really interesting. Second point, general point, with regard to the three papers, each of you was able to delve into one piece of regulation in particular, taxonomy regulation, sustainable finance, disclosure regulation, green bond regulation, but without neglecting the whole framework and the whole framework in sustainable finance, of course. And I think that this approach is particularly needed in this field because, of course, we have different set of rules, but the basic definition, starting from taxonomy regulation, are the same. And it's really important to be able to put together these different set of rules, avoiding extremely specific analysis and not enough general. So this is extremely positive from my point of view. And a third positive remark from me is the fact that each of you paid attention to the greenwashing. And this is, in my mind, really a crucial point at this stage, because we have to find solutions to mitigate the risk of greenwashing, because the risk is strong. You know, I think that all of us has this feeling at the moment. The risk is strong, and we are speaking about a risk that can have a dangerous impact in terms of trust in financial markets in general, especially for retail investors and so on. And so it's extremely important to find different solutions, but solutions to mitigate, not to eliminate, because I think it's impossible, but to mitigate this kind of risks. And you tried to find similar solutions. So this is positive. And so another point shared between you. Then, with regard specifically to Marlene's paper, I have to say that I totally share Marlene's concerns. First of all, with regard to the scope of the taxonomy regulation and in general the scope of green regulation. In my perspective, it's important not to create a sort of green niche, as you said. And I think that it is also interesting, your tentative to find ways to create a wider scope for this kind of regulation. And not only you have this impression about the risk of a green niche, and we have to find some solution. And another very interesting point from my side in your paper is the point related to the lack of a full ESG taxonomy. This is also a very well-known and debated point. We are now focusing on the environment, the E in the ESG acronym, but the point S, social, is particularly important, especially now due to the consequences of the pandemic and also the extremely serious socioeconomic consequences of this war. So the S in the ESG field is extremely important, but as you noticed, it's quite difficult at this stage to have enough precise and shared social standards. So I think that you have to put attention on this point and maybe to propose something more. I don't know if you want to add something at the end of this discussion. And the last point with regard to your paper, I think that you don't deal with the possibility to use technologies, enabling technologies, especially with regard to produce, gather, and circulate ESG data. Because I agree with you, data, ESG data are extremely important, and we don't have enough. And I think that enabling technologies, and so big data, blockchain, and so on, could help in this perspective. And there are plans, I think you know, that there are plans in Europe for a data central hub, a ESG data central hub, that could improve and support this expectation in terms of data. Many compliments, because your paper is extremely well done and complete and well organized. Turning to Antonio's paper, I found very interesting both the so-called intertemporal drawbacks and also the structural drawbacks, because as you said, at the moment, the technical standards arrived in April 2022. These technical standards were issued. But when you speak about intertemporal drawbacks, you speak about a more general point. And the point is the relationship, the interplay between level 1 and level 2 of the regulation. And so principles, more general principles located in the level 1 and more precise, detailed and technical rules situated in level 2. And I think that this relationship is really interesting to analyze, not only with specific reference to these technical standards that now we had, but more in general. And so I think that it's quite interesting. And also the other remarks on more in general about disclosure strategy and the efficiency of this kind of disclosure in the specific field of sustainable finance. I agree with you, and I find, can you hear me? Yes, so and so, because I had not a very good connection. But can you hear me, David? Okay.
We can.
Okay. So the point is that I found really interesting your observations focused on pre-contractual disclosure and websites, for example, because I agree with you, we have the necessity to be extremely clear, extremely concise with regard to retail investors, and maybe, I'm not sure, of course, but maybe the possibility to use different channels could hinder the final aim to be effective in terms of disclosure. So maybe you can add also something about this point. And last remark on my side, again with regard to Antonio's paper, I agree with you that it's important a cross-sectoral approach, also in sustainable finance field. This is a very general and debated topic at the European level. Better a cross-sectoral approach or a regulatory approach built on silos, vertical silos. And I think that sustainable finance could be an interesting field in which experiment a cross-sectoral approach, a little bit more cross-sectoral than now, because at the moment, also in sustainable finance field, the European approach is going to wide vertical silos. Maybe it would be possible to go a little bit beyond and to sustain a more cross-sectoral approach, as you suggested in a specific point of your paper. Anyway, many compliments also for Niccolò, because David is the formal discussant, but I really appreciated a lot your paper, because it's really difficult to put together such technical issues, MREL, TLAC, resolution, and so on, and apparently different field, sustainable finance, but your paper is really well done, and I think that there are many points to develop also for the future. Thank you.
Thank you very much, Antonella. As you said, I will concentrate a bit more on discussing Niccolò's paper. Nonetheless, to complement what Antonella said, I wanted to extend my congratulations to both Marleen and Antonio for their excellent papers. I just wanted to add a couple of questions so you can consider them for the discussion. To Marleen, I found. I think it was a really compelling case that you make about the critical assessment of the taxonomy. When you come to the policy proposals, you make three: enhanced disclosure of ESG data, coherent and full ESG framework, extending the taxonomy scale. And my question is this: are these stages in a process, or are these, I don't know if you're familiar with the concept of trilemma, that you can have like two, but you cannot have three. So my question would be that, could we get to have the three, or have the cake and eat it too, like Niccolò would say? To Antonio, who makes a very compelling, I would say, analysis based on an economic reasoning. But since you are addressing greenwashing, what is the role of liability for false information in all this? That was the question that was somehow hovering. After having said this, and concentrating more on Niccolò's paper, I think that I liked your paper very much. I have to say that it's unusual that people concentrate on linking bank resolution and sustainability. So compliments for this, because it's not the most habitual combination. I think that the benefit of your paper is the clarity of your thesis. Can you green TLAC and MREL instruments? The answer is no, because there are very clear reasons in the bank resolution framework why you shouldn't do that. There is an incompatibility, or at least tension and inconsistency between the fungibility of instruments and the earmarking of proceeds, and between the permanence and the redemption that would be needed in order to encourage actual green investment. So in that sense, I think that the main benefit that the paper offers is the clarity of the thesis and the attention to detail, because it's very well grounded on bank resolution principles and provisions. I have three questions for you in this case. You say that green TLAC and MREL instruments could give the idea of a preferential treatment of claimants in insolvency, but I wasn't entirely clear as to why. I mean, it may mislead investors as to that, but certainly if there is nothing of the sort in the offering documents, there is no reason why this should be a risk. Is this an actual risk? Beyond the risk that retail investors acquire these as a green instrument, and then suddenly they are subject to to both the disappointment of knowing that the funds are not properly invested, and then they are subject to bailing. But beyond that, is there an actual reason why this should pose a particularly important risk of misleading? The second point is that you expanded, you moved from the narrower point that TLAC and MREL instruments cannot be greened, something of which I think you made a very compelling case. But you made a broader case that the banking authorities like EBA, ECB, SRB, etc., do not have a sustainability mandate or a green mandate. I would accept the first narrower point, but I'm not entirely sure about the second, to the extent that the network for the greening of the financial system has been saying for several years now that climate risk is financial risk. Then I'm not entirely sure. Of course, they do not have an environmental mandate, but they do have a mandate to tackle the sources of risk, wherever they may come. And this seems to be a compelling source of risk. And that leads me to the last point. You focus on the fact that these instruments should not be marketed as green. But another point of this is the extent to which green factors or environmental factors should impact the bank resolution framework as a whole. As you know probably better than me, there are elements like loss absorbency factor and then recapitalization capacity. And when it comes to the recapitalization, for example, there are factors that need to be considered, such as the market confidence charge or the market confidence benefit. Those factors can be influenced by the perception of an entity's environmental stance and its exposure to brown risk. And so my point is, by focusing on the inability of greening these instruments, are we missing the actual point, which is that browner entities are more heavily exposed to risk? And this should be the actual point of the debate. So that's my last question to you. Thanks.
Thank you so much for this very interesting feedback. I got a lot of ideas from it as well. So thank you to both of you for your comments. I will try to briefly address them, trying to cover everything a little bit. First on this question of the greenish, not to dilute so much. I think in that sense, really, I fully stand by this idea of extending a scale and then keeping the green as green, and then not widening it too much and not trying to incorporate all kinds of transition activities in it, and rather avoiding this struggle of the fact that the taxonomy could be so niche by just extending it to a larger scale. And I think indeed with the question of data and data management, that technology could play a very crucial role in this and facilitate a lot of what is right now quite the struggle. I think it's also just a matter of time and until all of this is sufficiently aligned, and then I wouldn't argue that there should not be sufficient disclosure of data. I think it really underpins all of this. So there definitely should. This is not a piece where we should be scarce in our resources. Definitely not. On the question of extending the taxonomy to have an ES and or G or it's S or G covered. I think it would be very important to do so, more so with looking at the goal of the taxonomy to really provide a good, sound system, underlying system also for investors to really have different kinds of products to invest in and have then the trust that they follow with specific standards. I think it could be done, honestly, using a similar system to the one that we now use for the environmental standards. So also with a significant contribution or like a substantial one and do no significant harm. And then even possibly counterbalancing it by also having then minimum environmental standards that should not be crossed. But I would argue that it's useful to have these taxonomies next to each other, and that then financial products could either say, oh, this is this percentage environmental aligned and this percentage social aligned or so. But I don't think it would add to combine them all into one, because that would just create immense confusion and probably not really help to prevent greenwashing either, or then sustainability washing in a larger scale, I guess. And then I think it's also important with the social to keep in mind that it is different though. It cannot be as science-based, so it will be useful to rely on international agreed standards. And that some activities will be social by default, just for example, because any new business creates new jobs, and that is a social contribution in itself, but that should then not automatically be falling under the taxonomy. So it's also important to have a very granular approach there on what should be considered social and not. And then looking at the question of the different policy policy proposals and whether they exclude each other or not, I would say they don't. They can perfectly coexist, but definitely within them there are certain choices that where one would make one goal of the taxonomy harder to reach or better to reach or so. So for example, a full coherent, full ESG framework does could potentially allow for more confusion. It adds more complexity, it adds more data, it adds more costs. So that is a downside of it. It could possibly confuse investors even further. And then the question of enhanced disclosure of data, specifically when we look at SMEs, this could indeed, again, create more costs and maybe not be as beneficial as hoped for. So I think they are complementing each other, but the bigger question is to me, as I said in the very beginning with these two goals, what really is this taxonomy supposed to do? Do we focus on the idea that this is like a very good sound framework for investors to be absolutely certain that with each investment they do, they really get exactly what is on the label? Or is it more the goal to say, how can we incentivize all of these businesses to change and to become more sustainable and to change their business model? They are intertwined, but sometimes one objective and the other, it depends on the policy choice. So thank you very much.
So thank you both Professor Munoz and Professor Sciarrone for the whole remarks and food for thought. I will try to address them in order, but actually many more questions came to my mind, so I will really try my best to frame them properly. So as for the first point Professor Sciarrone raised, so the topic of the relationship between level 1 and level 2 regulation, and in particular the divide, let's say, between intertemporal and structural drawbacks, and how they can be also addressed in a wider understanding. Now, as you noticed, this funny thing happened that the regulatory technical standards were finally issued through this paper. I addressed that in the presentation, but I do think that actually this also strengthens the narrative that I was trying to promote and to develop, because actually the interesting thing is that when I address the problem of this gap existing between level 1 and level 2 regulation, was, I said, an intertemporal gap, hoping that the regulatory technical standard would have provided much needed clarity regarding some aspects. The interesting thing, and I said that during the presentation, is that the regulatory technical standard, the 6 April one, ended up being something in part different from what we expected, or at least missing something that was much needed. Because the regulatory technical standard ended up being kind of very much focused on the template, on the disclosure, rather than providing some clarity on some aspects that have been raised as worthy of discussion, and such as I said, a clear definition of what a light green product is and what are the benchmark under which we can actually assess them. And these aspects were actually very much needed in terms of investors' decision making. So they kind of engraved this kind of major problem, like an intertemporal shortcoming, making it become a structural one. And so that was one aspect. And the other thing is that it is very interesting to address this level 1 versus level 2 discussion, provided that we kind of, I mean, I say that into the paper as well. I do understand the need for having a principle-based system and a much more like flexible development or level 2 regulation that can contribute to that. But I do think that this works as long as we can kind of agree on what this level 2 regulation should do, because then when it was actually issued, it ended up being something slightly different from what we expected, and that is a major problem. Also considering that, like, the role that we do see for like supervisory authority in all this development. So as for your second point, it was about the disclosure structure more specifically, and retail investor protection, which is actually the core of the discussion, the effectiveness of these system. There are a couple of things that I would like to add, also like being a little bit provocative with regards to what I start to suggest, as you say, in the paper. I want to push that. So I have mixed feelings toward disclosure. I think it emerges pretty clearly from the paper. I mean, coming from behavioral and economic studies also, I know that there are like both pros and cons in that. And I do see disclosure both as especially the multi-layer disclosure that the SFDR contemplates, as both a vector for simplification of information on the one hand, as you suggest, but also as a very strong vector for dispersion. Because it is very difficult to think that an investor, which might be like the retail investor, so a non-sophisticated one, would actually look into different venues to find the different informations. And I do think that this might actually kind of promote some opportunistic behaviors by differentiating the information. In order to actually reach a simplification of the information, not only by like splitting it in different venues, what I would like to do, like very briefly, is to suggest also another idea and to throw another consideration on the table. And this comes from my analysis of the RTS now that they have been published. So when I was analyzing them, my thought was like, okay, it's not really a problem of where do we put information, but actually assessing if all the information required are needed for the investor to make a decision. So who are they directed to? What is the purpose that we are focusing on? Because I mean, disclosure are supposed to empower investors, at least the disclosure towards retail investors. Still, is the retail investor really able to assess the robustness of a methodology if you communicate that through disclosure? I would actually argue that this might not be the case. This seems to be more a disclosure that is related to supervisory analysis. So I mean, it's for supervisory authorities to figure out whether the methodology that you use is robust enough. It is difficult for a retail investor which has not a substantial alphabetization on this topic to be able to figure out that sort of image. So another idea would be not only to like split information and to spread it through different venues, but actually to critically re-examine what we really need for investors to make their choices. That could be a step forward in order to kind of improve that. And in order to do that, I mean, the cross-sectorial approach is also very significant. And that was another point you were touching. I mean, it is greenwashing is a horizontal phenomenon. There has been a lot of discussion. I mean, I am pretty confident with the consumer law debate, in which there has been a lot of discussion whether greenwashing statements should be, for example, punished under the Unfair Commercial Practices Directive. So whether that sort of statement should be deemed aggressive or misleading, depending on the characteristics. And of course, there are stringent similarities to that also, because I mean, we know that sustainable goods, may even be financial or not, financial products or not, kind of resembles credence goods. So goods by which consumers are not able to appreciate immediately the defect in terms of sustainability. And I do think that, especially by looking at what the European Commission is doing in the field of consumer, we can draw some significant inferences by like leveraging on these similarities. I mean, of course, coming from an Italian background, it's not by chance that even, I mean, a great professor of us, that is Guido Alpa, used to discuss the term investors by referring to it as consumer of financial services. I mean, the similarities are pretty substantive. I'm not saying that we should have a plain overlap, but I do think that financial markets regulation could leverage on some of the conceptual developments that we are seeing in in consumer regulation with regards of the interpretation of the UCPD. Lastly, with regards to liability for false information, that was the point that Professor Munoz was mentioning, so I think that I very fastly addressed all of them. I mean, that's of course a relevant body of. I didn't mention that specifically in my paper because, in my opinion, the real problem is not to punish advisors or, I mean, intermediaries for providing false information, but the actual problem was figuring out how to assess whether an information on sustainability is actually false or not, especially in light of those gray areas that currently exist on the basis of the taxonomy regulation on the end. And I mean, Marleen really underlined that, and I do totally concur, especially on the social problem. I do think that with regards to social sustainability, we have a huge problem also in terms of like establishing quantitative benchmark. That will be like a major issue that we are going to face in next year. And the problem so is to detect what actually constitutes a false information. So actually then applying the liability regime kind of comes as a needed consequence, but I do not see like super stringent problems with that. What I see is that we need to move a step backward and figure out what is a false information in that field. And in order to do that, we need more clarity on all these aspects. So thank you so much.
Thanks, thank you. Professor Munoz, I already anticipated you. I would probably ask you to kindly rephrase the last question you posed me, but anyway, so that I kind of get it, but possibly I would like to hear that again. Anyway, coming to the first point to the first question you posed me, whether this preferential treatment of ESG green claim is something of more of a perception or an inherent characteristics of ESG green bonds treated as a regulatory capital TLAC claims. I took this at first as this is mainly and firstly a perception issue, I would say, not something that is inherently part of the characteristic of the bond, as you said, where if the final prospectus regulation as well as the terms and conditions of the bonds clearly stated what is the creditor hierarchy and the insolvency cascade that is going to apply, well then as effectively there's no risk in that point, though is and so a perception issue if the investor thinks that the green status of their claims give them let's say an advantage in terms of loss exposure in respect to other assets, but of course the terms and conditions may and usually do that explicitly and clearly stated what is the ranking and the layering that is going to apply. But my question or my point will be, imagine you've got like a perfect use of proceeds and a perfect segregation of ESG related claims, and you've got DSG claims elected in TLAC. So these claims will be exposed to losses only to the extent that green assets mature and are exposed to losses. While in these cases, green claims would be inherently seniorized to other claims if losses are not arising and are not originating on green assets. So in this case, it's not probably a perception issue, and this is a very theoretical case because I am making the case of a purely and ineffectively green claims elected as TLAC. For all the prospectus that I have analyzed, this has never been the case, because I'm quite sure that prudential regulators and prudential authorities, also feeding, for instance, on the last EBA guidelines, would not accept something like that. So I took that as a perception issue, but remind that theoretically this may, if we accept segregation at full, then it may turn into a risk, this preferential treatment that is inherent and part of the claims itself. Second point, you kind of said, yeah, not prudential authorities, let's say the ECB, the Bank of England, for instance, for considering the Western world, have not in their mandate to pursue environmental related objectives, but of course they've got the mandate to tackle climate related goals as part of financial risk. I agree with that. My point that was mainly, and probably I started from what these authorities, and for instance I started from the example of the prudential regulation authorities, but I'm quite sure that under the SSM remit we've got the same thing. They got to do a balancing exercise. So they, for instance, under the remit of the PRA, you've got primary as well as secondary objectives, whereas primary objective is purely safety and soundness, so which are basically all related to the capital stability of the issuer, and secondary objectives may encompass, I'm not going to list them, but may encompass environmental related or sustainability claims. The point is that my point is that possibly they should do a balancing exercise, but always keeping in mind that that's why I said they should be neutral to the desirability of sustainable related claims in the capital stack, because they should bear in mind that safety and soundness should always be their guiding principle. And moving to the third point, if you, I probably I got what you were asking me, but if you can kindly.
The third point has to do with the last remark you made,
Yep.
because for some people, this is not a secondary objective. This is part of the primary objective to the extent that it poses a risk, and that was the point. So by separating them in primary and secondary, are we not simply downgrading the status of the climate threat, not just as a matter of physical risk, but also of transition risk, which is a major point?
Yeah, my answer here would be by treating them jointly, aren't we running the risk of not like, because in theory we may talk about primary and secondary objective. In practice, the dividing line may be so blurred. This is the risk actually. For instance, you've got this in insolvency law realm, when insolvency law are required not only to pursue creditor protection, but also, for instance, social tax-related claims, social-related claims, and labor-related claims. Aren't we going to kind of missing up things by like creating one bucket in which we protect everything? The answer is I don't know. The answer is I don't know. One point though is that that I would like, that possibly, and one position I like to take is that we should not, I think we should not treat capital as a policy tool, meaning that, or at least we should be clear in saying that capital is a policy tool, so something, an instrument for pursuing policy-related objective other than capital stabilization. This does not mean that we care less about other objectives. This means that possibly capital should be considered as a tool for tailoring, targeting, pursuing some objective, but not others. And there may be some other bodies of law. For instance, I use the metaphor of insolvency law, so employment law, taxation law. There may be other, so in the prudential regulation world, there may be other body of law that are entrusted with pursuing more effectively environmental related claims. And I'm not proposing anything here, but this is possibly a point worth taking, that to the extent that we are mixing everything in the primary objective sphere, there's the highly risk not only of being political there, so of giving priority to one to the others, as my point is there is whether these authorities got a political mandate. Some of them are. If you think, for instance, I'm going to go off topic, but if you take, for instance, the mandate of the bank of the Central Bank of China, but my point is that we should be asked in this case to capital regulation to pursue what is required to do, and maybe try not to blur the realm. Not that environmental sustainability claims and objective are not relevant. Of course, I'm not saying that.
Thanks very much. I think that we will just leave the floor to to the person who is responsible for this event happening. So Michele Siri, please, the floor is yours.
Dear David, many thanks for your introduction. In the interest of time, I have to announce the winners of our prize, and in behalf of the scientific committee, I am glad to let you know that in the third position has been assigned the paper by Antonio Davola, and congratulations, Antonio. Very useful paper. And in the second position, there is the paper by Niccolò Cirillo, and the first place is for you, Marleen. All your papers are of high quality, as the discussion of today has demonstrated. And I'm very proud of your contribution of our scientific project, both at Aylesfield as well at European Banking Institute. To conclude, in the interest of time, I have to announce also the next initiative jointly developed by the European Banking Institute and Aylesfield, together with Catholic University of Milan, our annual summer school to be scheduled in July, in the second half of July. It will be a remote summer school due to the pandemic. We hope this could be the last one, but you can find much more information in the coming days, both on the European Banking Institute website as well on the other institution websites involved in this project. So we can close our webinar just in time. And I thank you also Federico Riganti, who is the originator of these 4 talks. Well done, Federico, and stay tuned for the forthcoming events.
Thank you so much. Thank you all. Bye-bye.
Thank you, everyone. Bye.
Thank you very much.
Thank you very much to all.
Thank you, everyone.